There it is.
No.
Okay.
Okay, we'll call board of police fire pension board meeting for October 19th, 2022. Roll call.
I have everyone noted. Yep.
Look for approval of the agenda for today's meeting.
I'll move to the approval for the agenda.
A second.
We have a motion and a second. Any discussion? Hearing none, all those in favor?
Aye.
Opposed? Move on to the approval of the minutes from our meeting held September 7th, 2022. We just through those. Talk to the work team.
That's good. I'll make a motion. I'll second. Approve the minutes.
Okay, motion and second has been made to approve the minutes of September 7th. Any other discussion? Hearing none, all those in favor?
Aye.
Opposed? They're approved. We'll move on to the bank summary of assets and expense report and quarterly bank statement summary.
So as of 9:30, the market value of the portfolio was about 147.9 million, a loss of about 10.5 million from the August 31st balance. We had our quarterly administrative fees that came out and Raymond's auditing fee as well. No, on here. So there's the quarterly bank statement summary. Let me know if you have any questions.
Questions? If not, I'll take a motion to approve.
I'll second.
Motion second, any other discussion? Hearing none, all those in favor?
Aye.
Opposed? They are approved. Move on to board administrator reports. I have nothing.
I've got a question, I guess, to Jeremy. As I was looking at the assets, it looked like we're down over 20%. Total value of assets versus where our peak was, roughly. Looks like the market hasn't been down quite that much. So it seems like we're going down at least as fast as the stock market, even though we've only got 65% in stocks. Can you give us any guidance on what's happening? Is the bond market dropping faster? We lost more in bonds or something else?
We've got a chart on that, Ed. Yeah, we can get into it now or.
So we can wait. We can wait as part of
Okay.
your report. I just wanted to make sure that was being addressed.
Yeah,
Okay.
yeah. Essentially the worst start of the year in history when you combine stocks and bonds, right? So bonds are down year to date through September 30, about 15%. But when we look at the report, I think we'll see some outperformance versus the stock market, at least as of September 30. I think what you got to keep in mind of assets dropping is the monthly withdrawal every month for benefit payments.
Yep.
So we'll
Okay,
take a
good.
look
Yeah,
at
as
that.
long as the covenant's good. So I don't have anything else, Mr.
Yep.
Chairman.
Okay.
I have nothing.
Lily will.
Yep. Okay, so we have, last time we spoke about Paul Green, he terminated on 8/19. So he has requested to draw his funds that he contributed. And so we sent that request to Comerica on September 19th. We had a new fire employee, William Beatty. He's the new fire chief, hired on October 17th. I remember our last meeting, Ed had questions about like the death notice and how we handle that process. So I put that question out on the MAPERS site. A majority of the responders said they use a company called PBI Services. And then upon further review, we found out that Comerica actually already uses PBI Services on our behalf. So we don't have to pay anything additional to get that service. We're already being provided it. So they're basically catching most of our death notices across multiple platforms, not just Social Security. So,
And then they send you a
Yep.
note and they see it.
yeah, so it's just, it seems to be that word of mouth happens faster for us than them, because close knit community, or
Even though they're doing it daily.
they run the report daily and then they provide the report to Comerica weekly,
Oh, okay.
of everything that happened throughout the week.
Yeah.
So I guess we're just getting notified by the family members a little bit faster, but
That's
either
good.
way, we do have something in place.
No, it's good to
which
get
I
a
didn't
check on the
know.
system, yeah.
So now we all know.
We have use some shop.
And we have the shopper.
Yeah.
So if we ever were to switch banks and we didn't get that service from our new bank, it would be, as of right now, about $3,000 a year to have that in place to do that check for us. So good news.
Yeah, thanks for checking in.
Yeah, it was interesting to hear all the responses on the MAPERS website of how they handle things. Oh yeah, and then Ed, your question to GRS about the rate of return and what they think a reasonable asset allocation would be. I included the response in here. I don't know if you guys got to read over what Derek said, if that made sense to you guys. I don't know if you got to see it too, Jeremy.
You actually forwarded it. to
Oh,
me,
yeah, you're
yes.
right, I
That,
did.
that was helpful. I
Okay,
did get
cool.
to see that.
So yeah, basically, and we had a follow-up conversation with GRS last week just to talk about timelines, but Derek did say if the board decides to change their asset allocations at this meeting, he would take that into consideration with the actuarial report they're doing right now. So just throwing that out there, as he did say that.
And we came prepared to talk about this. We'll talk about the market, obviously, but I think this would be a big chunk of conversation as well, as far as asset allocation and what we're seeing from a expected return standpoint. So
You guys seen here they dropped even from 6% down to 5.87.
So that's a consideration, and that's, and Linda, Lily, or the city will be able to talk to that more than me, but that's because the administrative fees have been essentially not rolled into the plan to pay, correct? Or I should say they were rolled into the plan to pay. They weren't rolled into the contribution, right?
Mhm. Yep.
So that's something we've noted and we'll talk about, but you're right, that's what lowered it from 6 to 5.87. It's not really asset related. It's how these administrative fees are paid.
So if I understand, then we're essentially paying the administrative fees out of our fund balance. Right, so that's what they're trying to capture, that each year you have that.
Recorded as an expense
Mhm.
rather than offset against the earnings.
So they,
Just way of handling it. So
right, but are they thinking then that they didn't know that before, that it was an expense coming out of the fund balance? That's what they're changing. That's why they're making a change to their numbers. That's what I
I
read.
think it was a recommended assumption of them initially to actually put it into the city contribution. And since the board had approved to not put it into the city contribution, they changed the return
Okay.
assumption. Which I do think is probably something we just want to revisit, because when we look at return driven numbers, it's going to be, obviously just what are the returns going to be? And when you lump that 0.13% in, that's going to lower it even further. So when we're asked, how do we make a 6.25% return? To me, this almost is asking, how do we make a 6.38% return
Mhm.
because the 0.13 is reducing,
Yeah.
which isn't as typical of what we see, but that doesn't mean it's right, wrong, or indifferent. It's just another way, obviously, to think about that expense.
Yeah, for us thinking about it, it'd be nice to have the 6.25, right? So we're asking you the right questions. So if we wanted to clean that up, we'd have to essentially separate that out into a separate bucket that we say, okay, here, this needs to go into the millage rate. Is that what we'd be doing? You need to put this many dollars for this and this many dollars to cover administrative expenses. Is that how we'd have to do it to make it make sense?
Linda,
Probably, yes. that it would have to be something that would fall into the number that we're trying to generate out of the pension,
Yeah.
the millage.
Yes, either way, it's in there. It's just,
Mhm.
Similar to the.
we confuse the board of commissioners probably if we did it the other way by saying, okay, we need this much based on a return. but We also need to fund, we need some extra. Here's what we pay the retirees and here's what we do for the administrative expense. That would probably confuse them and muddy that message. I wouldn't want to muddy that message. Even though they would make it easier for us. Maybe.
But anyway, yeah. But it's taken into consideration year after year, it's just.
First time TRS is not a study.
I wouldn't think so. It's been sitting out there as an expense
Yeah.
for as long as we've been doing it. I mean,
Right.
it's-
Right, we've
it's
never
your-
separated it out. No, we've never. Mhm.
Now it's just strange that it just came up now.
Agreed.
Right.
And that's all I had for my report.
Okay. New business. Look at the travel report. For policy.
I did not make any changes to it. The only question I had at the bottom is we don't have a set time frame of how often we should review this policy. So I didn't know if you guys wanted to do like every year, every 5 years, or,
I think yearly is probably good.
Okay.
And then when we do that, if we can just line up a reminder of who went last,
yeah,
kind of let
Where
us
we're
know
at.
where we should start planning to attend next time.
Oh,
Great.
Yeah, because a lot of times I have a conflict when they do their
mhm.
conference. I've got one I've got to be at because I'm a recording secretary.
Yeah. Schedule it around you. neighbors.
No. And the oaks ain't gonna change when they do things, I'll tell you that. It's in our bylaws at the state level. So I do apologize for that.
Yeah. Other than that, I didn't see anything in the policy to change.
When it says all travel and expense records shall be retained for 6 years, is that by the board member or by the
I believe it's by the administrator.
administrator? Yeah.
Because we do have records of all that
Yeah,
stuff.
should we clarify that and
Yeah, that's a good thing to. Mhm.
be retained by the pension administrator? You guys okay with that? Changing, are you guys okay with changing that to say, all travel and expense records shall be retained by the administrator for 6 years, just to clarify?
Mhm.
That we don't need to retain it.
Good point.
You don't want to hold on to that.
I got enough paper. I probably will anyway, but then I'd have to find it. You're not gonna really help me.
Yeah, that makes sense. It should be on central location. Okay. That was the change that you wanted made.
Yes, sir.
Guess we, entertain a motion to make that change.
So moved.
We got a motion, a second. Any other discussion on the education and travel policy? Hearing none. All those in favor?
Aye.
Right, opposed? Been modified. Jeremy, we are ready for education from Cat Trust.
All right, fantastic. Well, we have, first of all, I should always check, does everybody see the agenda that's up and did it pop up okay when you, sometimes I know it locks you out. So we will give a market update, not only through the end of September, but through the end of yesterday. I'm doing that intentionally because it's been a good last 2 days in the equity markets, although today has been more rocky. We'll take a look at what we call a flash report that'll give us up-to-date performance. As a reminder, in our November meeting, we'll have quarterly attribution for all the investment managers for our more quarterly all-inclusive report. We'll also look at the expected return analysis. CapTrust did review some various emails from Gabriel Roeder. We also had a call before the last meeting with Linda and company just to kind of talk about what our thoughts were when reviewing some of their comments in the experience study as well. And then we'll talk about any action items for the November meeting. That sound good? So page 2 is just going to give us a brief snapshot of what we're seeing year to date through the end of third quarter or September. If you look at that far left column, and I'm kind of blowing up the top right table there. September obviously was a very difficult market, whether we're looking at stocks or bonds, but particularly stocks. So stocks were down over 9% just for the month, which brought their year-to-date total for 3 quarters of the year down almost 24%. Small cap stocks were down even more than that, over a little than 25%, and international stocks continued that trend down just a bit over 27. US bonds, I would argue, although stocks have been very difficult, would be even more of a highlight of what we're going to hit on in the report versus stocks. So if you think about Finance 101 going all the way back to maybe not elementary school, middle school, when stocks severely underperform, typically bonds hold up better or at least act differently. That has not been particularly the case so far year to date. Just in the month of September, they were down 4.32%. For the year, they were down 14.61. I'll show you some more detailed charts on that. But the bottom line is interest rates have continued to rise. We've had a lot of concerns around inflation, which has concerned both stocks and bonds. And with that, the Fed has made big impactful moves to raise rates. And they've also given us signs that they're going to continue to do that at a fairly aggressive clip until inflation is really contained. So what's the headline story in 2022? We have quite a bit of them. Inflation is one. The Russia and Ukraine war continues, which has really stressed, I would say, more inflationary concerns. We're coming out of this COVID environment, but I want to kind of give a caveat that with that, there's been more of a demand for travel and goods, which has continued to push inflation up. Mm-hmm. And so what's the number one, I'd say, headline for concern is when the Feds are raising rates and trying to control this inflationary environment, which again is rising prices, will they do so quickly that consumers like you and I are all around the world stop spending at a fairly quick rate, and then therefore put the globe into what we call a recessionary period fairly quickly. So these are really the main headlines or themes that we're coming out of. And of course, we're going to look at how the actual retirement system has performed in light of this, but difficult market. So the next slide, kind of the who cares to this. So what's interesting is we met at the end of the second quarter. It's represented by that first red diamond at the left of the chart. So for example, at the end of the second quarter, the Barclays aggregate, or in other words, bonds were down 12.6%. We really hit our very bottom level of bonds as of September 30, down about 14.6%. I would love to give you better news on that front, just globally in general. Now through yesterday, bonds are down about 15.5%, just globally, not necessarily the portfolio of Battle Creek. And I make that caveat because you've got some short-term bond exposure that have not dropped this much, which we'll hit on. Equities, we felt like we were bottoming it out at the second quarter. At least we documented things that way because third quarter really started off at a bang. Now third quarter has dropped to the point where we're down 25.5%. So that's a tough combination of you've got stocks materially down. You've also got bonds materially down. The S&P 500 through the end of yesterday is down about 21%. The Russell 3000 about the same. So slight uptick in the fourth quarter, but I feel like we're saying a little bit of this at the beginning of the third quarter, how we're getting an uptick, and it's been difficult. Again, I don't want to sound like a broken record, but a lot of concern around inflation and are people going to be able to spend as much as they are? And so we've had interest rates spike. And so now mortgage rates, we looked a year ago, they're on average about 3%. Now they're about 7% for a 30-year mortgage. And that really trickles into a lot of the areas of the economy. A silver lining that I don't want to go lost is the economy many times runs directly related to the stock market, but many times the stock market prices things in anywhere from 6 to 9 months ahead of time. So what I mean by that is when we see some of these concerns that come out of the economy, many times it's already priced in. And so you don't want to have a knee-jerk reaction to some of the media that comes out. So page 4, and I know I'm blabbing on you, so feel free to stop me with any questions. What does this look like compared to if we go all the way back to 1976, as far as what we have returns of stocks and bonds through the end of September 30? So every year we look back through the end of September 30, the higher the blue dot is, the better that calendar year did as far as bond returns. The more to the right that dot is, the better stocks return during that time period. So I always say, if this is a map of the United States, we'd rather live in Maine versus, we'll say, Las Vegas, right? We are smack dab in Las Vegas currently. The Northeast quadrant obviously has a lot of dots, meaning normally at this time of year, we're through 3/4 of the year. We've had a lot of positive returns. Obviously, there's been some where stocks are negative, which is more to I'd say the Northwest quadrant. But there we are, strictly in the Southwest quadrant. And you see how there's not even really any dots in that quadrant? There's one, right? And it's not even close. So very, very unique year for the stocks and bonds combined. Especially I would argue, as Ed had alluded to, so we're a 55 stock, 45 bond portfolio. We call that a balanced strategy, and it's balanced because really you would expect when one performs one way, you want the other to perform another. This has been a difficult environment for somebody that's all bonds, somebody that's all stocks, but obviously a balanced portfolio too, which again, this would be more of like a 50-50. Okay. Now, the silver lining, which I want to bring in, and again, I'm just sticking to the economy because it's been such a different, or I should say unique economy in capital markets. Then we'll look at the retirement system's return. What this shows is the market works in such counterintuitive ways. And what I mean by that is consumer sentiment, which means how confident people like you and I are that things are going to recover, is very, very low right now. So you look all the way to the right. This represents consumer sentiment all the way back to 1970. See how low that diamond is compared to what we've seen historically. On average, the 8 sentiment, what we call troughs, so all these diamonds, when we've hit low points and consumer sentiment begins to spike up, the 12-month return of the S&P 500 is just short of 25%. We don't try to have a crystal ball. We talk long-term with investment strategy. Don't come here and say, hey, 2022 is going to end fantastic, and this is why, or maybe even 2023 brings good things. What we do, though, is look at how data is looking economically and in the capital markets versus previous, and what we've seen from that historically. And typically right now, with such low consumer sentiment, because again, the stock market prices in a lot of these things, we tend to see a fairly substantial up spike in returns. To add to this, page 6, just the very next page, what this shows is going all the way back to 2002. Anytime we had a time period where at least 500 stocks in the Russell 3000 had a very attractive valuation. A technical way to say that is a price to earnings ratio less than 10, which means stocks are cheap. And we highlight these in red, these time periods. So you see that horizontal axis, that's 500 stocks. So any of these bars that go above 500, we highlight in red. Anything in blue, that means valuations weren't attractive. And then all these time periods we highlight below of how the 1 and 2 year forward-looking return has been within the stock market. Okay, so September 30th, was fairly flat, but I would argue the very next quarter when it happened, December 31st, 2008, you can see the market for 1 year is up 28%, 2 year up 50. And you can see 2011, 2018, 2020, especially on the right side of the table, there's substantial forward-looking returns. So these charts really just scream from an advisory standpoint to not try to time the market. There's a reason we do rebalancing, meaning when bonds or stocks get outside their 5% targets, which we've done over the past couple of years, we actually haven't gotten there yet as far as recently outside the 5% targets, but we want to stay disciplined. So when stocks are down more than bonds, that we continue to be allocated appropriately. Okay. So difficult market, both economically as well as the capital markets, which is returns, ups and downs. We do think valuations are attractive right now. Now, I always want to add the caveat, I'm not saying, hey, fourth quarter is gonna really shoot up. What we are seeing, though, is historically the 1 and 2, especially the 2 year forward-looking return, tends to be fairly attractive in difficult times like this. And again, it's because many times what we're concerned about economically has already been baked into returns, right? So a headline comes out as somebody missed their earnings. A lot of these larger companies are reducing their earnings. Well, the market already priced that in 2 months ago because of the concern of other media that came out. All right. I'll pause there, see if there's any questions, and then we'll look at the actual portfolio.
Trying to think what program I was watching, but one of the experts, one of the gurus, was saying this inflationary period is going to go on for an extended period of time, like way into next year.
And what has made it tough, I would say, Stan, is when the Fed first came out and started talking about inflation, they had said they were going to stick to a fairly slow and steady plan. And they have more technical terms than that, right? That has not been the case over the past 3 quarters. They've been aggressive. They've been 75 basis point or 0.75 increases numerous times. And so that's where bonds have gone down. I want to remind the board, as a long-term investor with the retirement plan, with the pension plan, when interest rates rise over the long term, that's not necessarily bad for your plan. There's a couple of reasons for that. In the pension plan, when interest rates rise, typically liabilities fall. But also, bond managers are now going to get more returns over the long run without taking as much risk. That doesn't mean that something that we just looked at isn't painful, from a bond depreciation standpoint. But it's happened so much more quickly than what we've seen really throughout history. So page 7 shows assets as of September 30th. So kind of that total category. And I know we just looked at the bank summary of assets, 147,917,937. We'll show actual returns, obviously, of the plan as well. Something to keep in mind of, typically, if we were to have just no returns, meaning if we were not down or up, there's 6 to 7 million every 2 quarters. So we'll say 3 to 4 million every quarter that's typically withdrawn for benefit payments and fees and such. And that sounds about right, I would say, right? So now there is $1 million quarterly contribution too, but when you net that out, that's just something to keep in mind. So if we were to stay flat forever, obviously we would run out of money just from the quarterly distributions. Of course, it's our goal to not stay flat, and we'll look at long-term performance, right? That's the whole reason we invest in risky assets or risk-based assets. But just for an example, in the third quarter, 4 million was withdrawn. There's about 1 million that was contributed, 3 million in monthly benefit payments or a little over, and then there's insurance premiums as well. So page 8 just shows asset allocation. I'm going to hit on an even more recent summary than this because, again, there's no required balancing yet. And then page 9 shows asset manager returns, again, as of September, which is all the way to the left, quarter to date, and then year to date. So when you look at year to date, I'm going to focus on that gray shaded bar of total fixed income. The portfolio's, just the bond exposure, is down 12.21%. Again, the Barclays aggregate would be down more than that through September 30th, about 14.5. The reason for the cushion there is you do have what we call lower duration bonds that typically hold up better when interest rates are rising. Now, that fund forever has been fairly unpopular because we haven't seen a rising interest rate environment. So we're talking about why it's underperformed in certain environments. Well, now we're finally seeing that. When you look below in stocks, again, the quarter to date has been rough, but obviously year to date stands out that much more. And so the year to date portfolio return is down 19.96%. The quarter to date was down 4.84. So the question is kind of, how does that compare to the general market? Well, stocks at the end of September 30th were down over 25%. 25% was S&P, and then again, international are down more like 30. And then you've got the bonds as well, which were down about 15.5. Your bond portfolio did outperform, but not like substantially, just by a couple of percent. So I think to Ed's question, there's a couple factors here. Number one, obviously the markets in general. number two would be when we look at the overall portfolio and why our assets depreciating, we've obviously had just more withdrawals and contributions too. So, all right. As of October 18, I'll just skip to page 12. Slight uptick through mid-October. So you look at the top left, it'll say 149,348,938, which captures a little bit of an upmarket. But again, this has been such a day-to-day process, which we don't get stuck in, by the way, but we do look at daily. So, hey, is there required rebalancing? But the pension plan continues to be within the targets currently. I will pause there before we go into the expected return analysis. Anybody's free to yell at me about the market. It's
Not your fault.
been definitely a frustrating environment. There's no doubt about that. And again, I would argue, I know it sounds like a broken record, the bonds, stocks, we have periods like this. Bonds have depreciated and they've happened very quickly. And again, for a long-term retirement investor, you certainly don't want to invest in cash either, but that's really been the only positive performer. Now, I will say the city has a 3% target in cash, but that's normally based on, monthly distributions.
Yeah, just have a reserve there.
That's right. That's right. All right. So now we'll go to the expected rate of return analysis, and we'll start on page 15. And some of these I'll take fairly high level, but please feel free to slow me down with questions. So this is something we take into account on an annual basis when we look at expected return to see if we have not necessarily material recommendations to the asset allocation of the retirement system, but also the sub-asset classes. So, okay, based on risk and return, do we want to increase international equity, decrease international equity? I will say the Public Act is a little bit more limited than, let's say, a private pension plan, because you have limits on how much you can go into certain asset classes. So what we show on the left, and I'll start with where it says equity markets, is just different 10-year annualized returns that are assumed. So for example, US large cap equity, 7.25%. And then the amount of risk, or in other words, the amount of ups and downs over a market cycle, 7 to 10 years.
So that would be, so for that example, US large cap equity, risk of 15.5% would be, it could be plus or minus 15.5 within the next 10 years. Is that how you measure it, or how's that measured?
Yeah, essentially, yes. It's within a 2 standard deviation space, they say. So I would look at it, we'll have an illustration, Ed, but I would look at it just, yes, the higher the standard deviation, the more variance there will be around the returns. Yep. Okay. And we call it, so a 1 standard deviation and a 2 standard deviation event. So it kind of depends on the asset class as far as how material that 15.5 is.
Mm-hmm.
But I would say it means a 1 standard deviation event, the 15.5, you'd split in half and you'd add it. So half of 15.5, that's exactly right.
So it's 2 standard deviations, plus and minus 15.5. That means 96%, if I remember correctly, of the time, 96% of the time you'll be within the 2
standard deviations.
Is that right? 96? Or?
I think it's 95. 66 is 1 and 95 is 2.
All right.
Yeah.
Not
Don't put that in the
100%, pretty
notes. I'm not.
close.
I won't.
But
I won't.
I think it is. Yep.
I guess the other thing I noticed on this is that when you compare it back to like some of the fixed incomes, most of those are up in the 5 to 8% range, or 5 to 6% range.
When you look historically versus now.
Yeah. So looking at fixed income, this has been an unusually, obviously big variation in bonds right now. But even long term, even though we're talking about being 15.5% plus or minus, even if you're in bonds, you're already plus, let's say, plus or minus 6%. So
Huge. Yes.
I think our risk, if we did move some more assets into stocks, would be like a plus 12, or not that much. I'm sorry, plus 10. Plus 10 versus where we are now with the money in the bonds, probably. And it would be, if you'd say we move 1/10 of our portfolio there to that 10% higher volatility, so multiply it by 0.1, 10%, you'd really only impact our total portfolio by about plus or minus 1%. It's not a big.
And we'll try to materialize that with some numbers. That's well said.
That'll help. Yeah,
Yes.
that's something just.
Yeah,
my head,
yeah.
but yeah.
And a natural question is, okay, let's say it reduces it by 1% in the long term, but what happens in a dot-com bubble? What happens in a housing crisis? Because that's when it's really tough to stomach, especially from a funding perspective, understanding there's smoothing. But we call that funding volatility. You know, what's the worst that can happen in a bad market, right? And we'll try to take a look at that too. Something that sticks out though is under fixed income, the US core fixed income return, only 2%. So that's very low. The reason that is, and these are all as of 12/31. So whether it's Gabriel Roeder or these different advisors they'll use with their averages or ours, we essentially do expected returns once a year. So when the US fixed income return of 2%, which again is a long-term expected return outlook, it's assuming interest rates will rise and bond prices fall because they were low for so long. Well, what do you know? Here we are in 2022, interest rates have risen, but they've done so quite substantially. So my point of highlighting that is these definitely can change as of 12/31 of 22, or in other words, next year when we're looking at these, it'll be interesting to see where they land because interest rates have risen, right? Page 16 just shows a visual of this, and it kind of really lays out what Ed had hit on. So your current targets are on the top. So I'm looking at the top table. It says current targets there, and it shows basically the higher that dot falls, the more of an average return you'd expect. The more to the right it falls, the more of a standard deviation, and the more the risk, the ups and downs. Okay, so the hypothetical one. Well, let me back up. Current targets is 55 stock, 45 bond. That's the current targets that the pension plan have. And then we show three different hypos. Number one is if you were to move to 60% stock, 40 bond, in other words, 5%. Hypo 2 is 65 stock, 35% bond, you move 10%. Hypo 3 is 70% stock, 30% bond. So that would be moving 15% of the portfolio. From a returns perspective, let's just move to one more page. I think this will be more clear. The reason why we picked that is if you look at kind of that bottom table there, your current targets, we'd see your expected return over 10 years to be about 5.68%. If you were to move to a hypo 1, the median would be about 6% return. And the question that was posed to us is, what would the asset allocation be to have an expected return of 6.25 to be reasonable? We would look at more of the hypo 2, or again, 65 stock, 35 bond to fall at that 6.32% from an expected return standpoint. Again, 7 to 10 years forward looking. I'm going to add a little bit more color commentary of why that's, I don't want to call it counterintuitive, but the reason these are lower is because stocks and bonds, but definitely stocks, have done so well over the last 5 to 10 years. So it is a little unique to have stocks do so well over 5 to 10 years and then look at expected returns and say, well, now we're going to move more aggressive in order to bump up our expected return. And by the way, I say unique. Other plans have looked at that and some are doing it as well. It's just we think of returns as an asset manager a little different than an actuary because we're thinking, well, we've had all these great returns. Yes, expected returns lower, but we think even 20 to 30 years out. Gabriel Roeder in their reports really thinking, hey, we look at 10 years, we still call that long term. And these are the numbers that are challenging your assumptions. Okay. And so what do I mean by that? If we move to page 21, again, the retirement system is the navy blue bars, which shows how a 55 stock, or again, your current portfolio, 55 stock, 45 bond return has been. 10.7% over 1 year. You can see the 3 year, 14.62, 5, 10, 15, 20, 30. So as an asset manager, when we're thinking of long-term returns, we definitely think about the expected returns, again, especially to make tactical changes over time. We're also thinking about the 20 and 30 year returns. So you can see, although our expected return for the current portfolio is under 6, the 30-year return has been a little bit over 8. So we just always caution the board to kind of think about, not somewhere in between it, but this 10 years is unique compared to what we've seen historically. So again, it's the decision of, do we want to move to a more aggressive asset allocation because of this lower expected return, understanding that historically we've actually seen quite a bit higher than that. And of course, as an advisor, I come in, we don't try to guarantee results. So in the long term, it's going to be, it is going to be, and I hate to be Monday morning quarterback now, but we were saying at the beginning of the year, returns could be more challenged, right? We saw these expected returns. Did we anticipate this in 2022? Well, this has been unique, especially because of bonds, but something to think about.
I think in the past, we've seen similar type periods, let's say, where both stocks and bonds just didn't balance one another out like they
Sure.
normally
Yep.
do. I mean, but it's been for brief periods
Mhm.
where this is tending to stretch out.
Yeah, we'll have a chart in our quarterly report next month that just kind of shows that. And again, bonds sometimes are slightly negative and versus stocks, but you're right, it's shorter time periods and then they bounce back, where this has just been so substantial.
We're out of the norm.
We are. So page 22, just the very next page, shows these types of portfolios and how they would react in what we'd call certain recessionary periods or certain market corrections. So in the financial crisis that started in November of 2007, for example, over on the left, your current portfolio of 55 stock, 45 bond would have been down almost 31%. You can see kind of that 2 columns over, the more greenish bar, which would be 65, 35, would have been down, 36.2%. So a little over, almost 5.5%. The dot-com bubble, again, when we're moving from left to right, COVID environment. So some of these returns aren't that substantially different. Some are. I just think it's important to view, your more aggressive portfolios typically over the long term will outperform. These are what we've seen in the past from a simulated standpoint of how much it corrects from an asset standpoint. And so I'll kind of pause there and I guess I'll leave you with, before opening it up for questions, and there's other slides we can hit on. Gabriel Roeder, clearly when they do their experience study, they're looking at that expected return over the next 10 years. And like us, they're saying, well, that's below 6.5. And I know we said now 6.25 is a reduction. Obviously, the portfolio can be positioned more aggressively, or the other alternative is more funding, right? And so typically, and I don't know if this has been done with the city or the board, there could be modeling that's done. Well, if you move the expected return to X, here's how much more funding there'll be. And there's a lot of different assumptions, but that's kind of where I'll pause on the conversation. Asset allocation can be adjusted. There's obviously other levers to pull too.
Stan, can I interject
Sure.
just for a second as you're thinking about this whole conversation? Gabriel Roeder will use the 6.25% that the board voted on to do the funding percentage, to decide how much has to be
City's
funded.
contribution, right?
The 6% will be used for the calculation of the liability that goes on the books of the city. So when you're thinking about, impacting the funding, you're at 6.25% as the actuarial assumption.
Yeah, that goes into how much the city will put into millage.
Exactly.
Okay.
Right. So the 6% that, Gabriel Roeder has been, touting is what they'll use for the calculation, the actuarial accrued liability.
Unless we make a motion to say we're gonna change our asset allocation targets to get to a 6.25% return, then they would put that in.
Then they would, but really the only impact to that is what goes on the books of the city, the government-wide financial statement.
Liability.
Yes, the liability.
And whether they support our.
Yes, but
that's
really
from an actuarial standpoint.
from a funding perspective and the impact to the millage,
Mhm.
they're going to use the 6.25,
Okay.
right? Yeah.
I mean, if we could
Yeah.
left right with the 6%, whatever they had put in their report.
Yeah.
The city's contribution rate would have doubled. I'm sure the commission would love that.
Well, and there's a lot of other things that go into the calculation of what that funding percent needs to be. I mean, we've made a lot of changes in benefits. We've made a lot of changes in employee contributions. There's a lot of factors that go into that, you know, besides what the city's contribution has to be, just to kind of keep that in mind and just to keep that in mind. Okay.
So help make sure we're centered on the right kind of thought process. So our current stock is about 55%. That's our current stock target. The Public Act allows up to how much to be in stock?
Ooh, I'd have to double check that as an upper limit.
Is
Yeah,
it 60?
I think it's higher. I think it's higher than that.
70 is a number that's sticking in the back of my mind, but I'm not 100% sure.
So I mean, interesting was and I thought Jeremy made a great point earlier, among other great points, but that doing about $1 million, was that a year you were looking at? Or a quarter?
So per quarter, $1 million's contributed and 3 to 4 million
Was out.
needed.
Yeah, so we are set up in such a way that we're relying on investment returns, which pretty much means stocks, because bonds aren't going to give those kinds of investment returns. But we haven't really gone as aggressively as the Public Act would suggest we probably need to, or could, obviously, you know, could responsibly go. So my instinct is we do want to go further down that road toward more stocks. That's maybe my first just observation. Further questions would be helpful to think about this. So did you say you did run a scenario? You know, I saw your hypothetical 1, 2, 3. How do those relate back to what percentages in stocks?
I think the option 2 was at 65%.
So if we look at the 4 options, the left or the first is current, and then it goes 60, 65, 70. So each one's a 5% increment.
Page 16.
Now, what if you adjust the sub asset allocations and move more into large cap or something similar to that? Is there a better performing sub asset that we could move more aggressively into to help that? So I'm also in favor of looking at going heavier into stocks, but do we adjust the sub asset allocation as well to try and justify that, so we don't have to put maybe as much stock bond ratio into it and just go more aggressive at certain?
Yeah, I think when we set up our targets, it's basically the 65, 35 if we go to that. Our investment people decide which pigeonhole.
And we
If
the
they
money
give the
is-
recommendation to us, we decide, right? They give us a recommendation.
Well, you have to move money between money managers. They make the recommendation.
And each year we do look at something called an efficient frontier. So, okay, of the 60 stocks, based on return potential as well as risk, how do we want to tweak the asset classes? So, for example, you'll see Hypo 1 and Hypo 2. International equity stays at 15.5 and even up to Hypo 3. And you're like, well, that's kind of interesting. Why do the others change? It's just the risk we see in international equity right now. And the Public Act does have a limit of 20% of the overall portfolio. And again, we can kind of recheck these. There's moving pieces. But we want to be cognizant of that as
Or
well.
you can't hold over a certain percentage in any one.
That's exactly right.
Yeah.
Yep.
Chairman, can I share something on risk here? I just want to make sure I've got it right.
Sure.
Jeremy jump in too. So if we're gonna move 10% to stocks, I would just want to evaluate what risk this provides for us. So if we move 10% to stock out of $150 million, that's 15 million. Okay, so that would be how much money we're making more risky. Of that $15 million, is going to have an additional 10% volatility, because he said that the volatility of stocks is 15, the volatility of bonds is 5, roughly. So that's 10%. So if we move 15 million over, our swings are gonna be $1.5 million up or down, which to me, you good with my math there and
Yeah,
logic?
yeah.
So to me, that I feel pretty good about that. It's gonna be a little more risky for us. It sounds big, 10% more risk, but it's on a small amount of money. And I'm feeling like that's a pretty good
Trade-off.
trade-off for the kind of increase in investment returns that we're seeing and the need for our retirees.
And it's not like we have to jump out to that 65% right away. I mean, it can be a gradual movement, I would think, depending on what the market looks like. I mean,
I guess is
but it just kind of,
We
What would be
typically,
the-
with that small of a change and updating an investment policy statement for the board and everything, we typically look to move at one time. Doesn't mean we have to, but
but-
yeah,
I mean, there's options.
yep, there's options.
yeah, and I like the idea of moving more quickly because of your slide number 6.
If that.
I mean, that's just shows
Yeah.
the PE ratio. So the PE ratio is price earnings ratio. So it's stock price divided by your earnings. So what it's saying right now is that stock price is really low relative to the real earnings of companies.
It's a good time.
Amazingly low. Yeah, this like what an opportunity hardly ever happens. So I'd almost be like really anxious to get this moved if we could.
Now the flip side of that is we're unfortunately selling bonds at a very low point too. Now I'm not, it's not even a devil's advocate view. I would almost say the good news is from a timing perspective, you're kind of moving one asset that's down into another, but you're clearly moving into stocks that are down that much further.
Yeah,
you know?
actually, to me, it is less important that they're both down. It's more important is that one of them is going to go up a lot faster than the other.
Absolutely.
Right.
So maybe
Bonds
the bonds are
gotta be pretty
down.
more stable.
Yep.
Yeah, bonds
absolutely.
are never going to give us. They're not going to bounce back necessarily in that huge return, but
Right.
stocks probably will.
Right.
Historically, and you showed another chart that showed in a situation like this, 90% of the time or 80% of the time, it's going to go up.
Yep.
50 or 70% or.
Yeah. Yeah. The
So
famous
it's-
line is, we can't guarantee returns. What we can tell you is every single time the stock market has dropped substantially, it's
Yeah.
come back up, right? It's just hard to tell how.
Yeah, so I'd be
quickly.
sad if we missed this opportunity. I'd say I want to go pretty quickly if we can. I feel like
Okay.
having evaluated historical
That makes
risk
sense.
return ratio and done the math to say $1.5 million, we're okay. Even if we get that volatility, we go down $1.5 million, it will go back up $1.5 million likely. The best bet we can make is that if we lose that, it'll go back up again. Yeah.
I can remember seeing a graph. It was from inception with the stock market. When it valleys, the next peak is always higher. It'll
Yeah.
dip, it'll go. I mean, the market itself is gonna adjust itself periodically. It's gonna be big sell-offs and some of that is programmed. But now this is just based on the economy. Sucks. At least I know my preferred comp does.
Yeah. So would a motion be in order?
To move ahead with to 65
Yeah, to change our pension
investment
fund
policy.
investment target from 55 stock to 65 stock, pulling it down out of bonds.
Yeah.
Yeah.
In motion. To approve that.
Yeah, I'd
I
like to make a
assume you're
motion.
making that
I'm
motion.
making a motion. so. I was just, that was like,
Yeah.
yeah.
We got a motion to adjust our stock exposure. Is there a second?
I'll second.
Okay, we got a motion and a second. Is there any further discussion?
To be clear, your motion is for 65% stock,
Target, yes.
35% bonds.
That's correct. Or I think there might be a little cash here,
But there's,
but yeah, to pull it out of bonds. So,
Yeah.
yep, exactly.
Yeah, to help with that, we will rebalance to the targets that are in that hypo 2 on page 16. And so what we'll do is draft a trade sheet that will actually show these essentially proposed trades, which we would send to the board. It's typically standard Tammy to sign, execute, and turn into Comer.
And I don't want to push you guys if it's going too fast. If you want to have more discussion, I'm open to it, but kind of where I am.
Okay, motion and a second. Is there any other discussion? Hearing none. All those in favor?
Aye.
Opposed?
So we've noted that. We'll work internally to get trades drafted and send them over.
Any I guess that's too late. We voted. I was just gonna ask anybody their opinions in the room, but
That comes up next under public
Yep.
comment.
yeah, that's good.
So from an experience study standpoint, to me now, reviewing that, it would make it reasonable to be 6.25%. Now, I don't know how granular Gabriel Roeder is going to get with that 0.13. You know what I mean? Because we assume here 6.32, which we would round to 6.25. And I'm looking at page 17 and typo 2. So we assume 6.32, which again, we would just say that's what we need for a 6.25. Are they really going to get as granular to say, well, we need to take 0.13 out of that? I'm not sure. And I don't know how big a deal that is. But we would never recommend 1% more in stock. That's not how asset allocation really works. And we would look at that as we're getting a little too wrapped up into expected returns.
Here, let me ask a clarifying question. There's on the same chart 17, you're going from 5.68 currently to 6.32.
Correct.
That's an improvement of 0.64 points. Gabriel Roeder is only asking for an improvement of 0.37 points, if I have it correct. So there's some disconnect here in terms of the starting point. I think we've got a much bigger increase here than even Gabriel Roeder is asking for. So,
Well, I'll clarify a little bit. So Gabriel Roeder, when they said their assumed expected return, it really wasn't 6%. It was lower. They said the most comfortable high end of the range they were willing to go to is 6%. So they said if you want to bump that up to 6.25, which again would be a high end of the range, they wouldn't be able to rationalize that based on your current asset allocation. They would need more data to show that's
so we're 632, which is kind of in their ballpark, but
right.
And if they say we're 0.5 or 0.5 short, I guess it's too bad.
Yeah, right.
Yeah.
Easily explained.
In a few weeks, we'll
Take the
find
asterisk.
out after.
What's that? Yeah.
I said, we'll take the asterisk.
I thought you meant
It's all
take the axe out.
Yeah.
We got those in the fire department.
And we'd absolutely see it the same way. I didn't want there to be confusion if for whatever reason they came back and said, well, so I think we're all on the same page.
So I guess I would communicate to GRS then that we're at 6.32, which is actually an increase of 0.64 points versus where we were before.
But they have to look at the information that was submitted as of June 30.
And I don't want to
For
confuse
this
things.
next
They look at
report.
both geometric and arithmetic returns, which we do too on page 16. So geometric are always less. And what that assumes is what we call volatility assumptions. So basically, if you have a really, really bad year at first, so let's say you're down 50%, we don't anticipate that, you're down 50%, you really have to make 100 up to next year just to break even. Does that make sense? So that's what geometric return ties in. We also look at arithmetic, which is more of an average. Gabriel Roeder looks at both of these too. So we typically focus on arithmetic, what we're just looking at when we talk about assumed rate of returns.
Thank you. Great job. Yeah. Appreciate
Appreciate
it. Very helpful. Yeah.
And Linda will be prepared to explain this to the commission. What we putting together next year's budget, they're saying we have to contribute.
She's saying Aaron will be prepared.
That's what
She's thinking.
Nice.
Aaron's first.
And I guess you can tell them that the board did take action to try to reduce that to the extent possible for the future. Yeah. Well, and actually reduced it this time because we took it from 6.5 down to 6.25. I know we-
Yep,
Yeah.
that's right.
Yeah.
Yep.
So with that naturally happening, we've changed our asset allocation to try to.
And Aaron and I have started a
Support the
conversation with the
taxpayers.
city manager, so, the budget team is aware.
Okay, they can get the right talking points in that. And
Because we've gone to the 6%. They're looking at contribution rate of 46.52%.
Yeah. So I guess maybe that's
So we're
part of it.
minimizing. I mean, we're going with the 6.25, it's going to go from 34.87 up to 41.62.
Wow. So I guess maybe the message is that our actuaries said, oh, you need to take it down to 6. And we were able to only take it down to 6.25 by really taking a look at, again,
that
our asset
issue.
allocation and the risk levels and all that. So
We also,
that's the talking.
yeah, the other mission one was really serious when we're talking, well, maybe we should go down to 5. On this handy dandy little sheet.
Yeah.
And the contribution rate would have been 62.5% payroll.
Right, again, and to us, there's a balance between expected return over 7 to 10 years versus what you'd expect 20 or 30 years down the road, which to me is more of a long-term pension plan. There's kind of a balance there, you know.
Glad we didn't do that to you in your first year here.
Yeah, I appreciate that.
No. I got myself in here.
I heard him thinking, burning the bridges up.
So we'll make a rebalancing schedule that shows which funds we have to trade out of to move to 65-35. We'll stay consistent with the new targets that are in this typo 2. And then we will be bringing out an updated investment policy statement for a future meeting that documents these new targets.
Cool. And then to Jake's question, can you bring back in the next couple meetings here, something around sub-asset allocations, just to
Sure.
maybe answer his question about what are the opportunities versus the risk? What are the, how does efficient frontier work? You know, the way you think about it.
Yeah, absolutely.
Yeah.
Yes. In summary, page 15, and I promise I won't keep you guys long, but just kind of from a finance standpoint, under equity, US large cap return 7.25%, risk is 15.5%. We could put more in mid and small cap, but to only achieve 0.25% more long term, the risk just doesn't add the appropriate amount of return that we would look at. And that definitely stands true, you know, for some of your international markets as well, because return is less. So that's the basis for it, but we'll absolutely, we can revisit. And I think what would be meaningful to the board is when these are all updated, first quarter of 2023. It's so strange to say, but we'll take a look and say, how did these change? You know, so.
Good. That's helpful. Okay. Risk return.
Okay.
That's it with Jeremy. Guess we can move on to public comment. Do you have anything else public?
I don't. No. Thank you.
So Stan, we have
Yes, sir,
public
Mr.
comment.
Love.
So Chris Love, 32 Mauer, retired Battle Creek firefighter. I will start with the easiest question I have, the comment I have, and work backwards from that, I think, in order. So, what's the time frame that it takes to do the like house and to have it done?
Typically in the next week. Yeah, it would be fairly fast. We look at current asset values and then, as again, kind of compare to the Public Act to make sure we're all good to go from a target standpoint, and draft a trade sheet and have it signed and submitted.
Okay. My next question is probably, maybe Linda would have an idea on it. I've been reading a lot about the governor and billions of dollars that are available to boost or prop up pension funds. So what would we have to do to qualify for that? And was that a consideration when we were looking at the assumptions we were making? Because maybe having a lower assumption then would qualify us for more of that funding to come in. And if we're too funded, we're probably not going to qualify to get any of that money. But if,
And a couple of things. So they haven't actually determined what the qualifications are yet. So we don't know. Our MERS plan is under the state's threshold of what's considered minimally funded.
right.
And so we're thinking probably those will be the plans that maybe we'll get the money first, but they're saying that funds will be available for all plans. And I haven't heard anything about, them saying, well, you have to have this or that or the other assumption.
Right.
I haven't heard anything like that. So things are still getting worked out at the state level for that, but we really are paying close attention
Because
and watching for that.
I would think that's something we should be,
Oh,
because even if it
Absolutely.
meant making an assumption change to
Yep.
help qualify, it would be, I mean, if it's gonna be money available, why not get it? And then what is MERS using as their assumption for a rate of return right now? I know it was
It's-
greatly debated for a long time.
It's higher. It's
Okay.
higher than than police and fire pensions.
So, yeah, it's they
Yeah.
recently reduced it from 7.35 to 7.
Yeah.
And I
But-
did write down their asset allocation. Because
Yeah.
that's a popular question,
Yes.
and they're just
Yeah.
simply more aggressive.
Mhm.
Their IPS is also a bit more complicated. We'll put it that way. It doesn't just have stocks and bonds. It's got a lot of what we call hybrid type strategies. So
Yeah, so if you guys could just keep an eye on that and be mindful of it, I think that would be a good thing in the future because you wouldn't want to miss out on maybe incorporating some of that funding. All right, let's see what else do I have here. I also am concerned, I know you guys are probably aware of Public Act 314 of 1965, which kind of is what I think Jeremy was referring, kind of is the controlling act over the pension stuff. Well, in it is a subsection, I think it's 20H maybe, but it talks to whenever a pension benefit change is done, that there must be a supplemental actuarial analysis performed. And I think that this has been overlooked somewhat. I'm only aware that I was the union president for quite a while for the firefighters, so I was aware of it. We would always try to do it if we did make a change. For example, when we went from best 5 out of 10 to 3 out of 5, we had one done. Other times, if you're making anything that affects a benefit level paid out, so like that. So and I hate to pick on the battalion chiefs union or them, but they're just one I'm aware of, and probably some in the police department maybe that are happening. We got to make sure these are done so that it's accounted for. The one I can think of recently, the BC's got a $4,000. They had a letter of agreement where they got paid $4,000 to make a letter of agreement to waive a certain right they had. That was right in the letter of agreement. It said that it would be included into their FAC. Well, there's only 3 of them. You would think no big deal, but if you just do the simple math on this, $4,000 times 3 people, averaged out over a 3-year period, times 75%. If they each collect a pension for, let's just assume 20 years, that's cost the pension system $60,000 that needs to be accounted for. The Public Act 314 says those actuarial analysis, the supplemental ones, are supposed to be performed and given to both the decision-making body, meaning the commission, and to the pension board 7 days prior to any vote on it. And I just
I
don't
don't
think
think
that's
this
happening.
pension board for the 40-some years I've been on has ever seen one.
And my thought on why, maybe you can then reach out to your lawyer, to Van Overbeek, and ask him about it. But my thought on why you guys are supposed to get it 7 days prior is so that, hey, if you see a red flag or something on it, you can make some comments that then go to the city commission that they can take into account before they vote on things. So again, I'm for everybody negotiate the best deal you possibly can get whatever you can get in your pension. That's fine. I'm great with that. I just want to make sure these things are accounted for because we're all eating out of the same bowl. I know you guys have a fiduciary responsibility to make sure that these things are accounted for. And there's other examples, like I know in the PCs, again, to pick on them just because I'm familiar with it. In their contract, previous to the contract they're currently under, there was nothing in there that controlled what went into their final average compensation. If you look at the handout from Gabriel Roller Smith, they had a list of certain things that they were assuming. Well, now in their new contract, all these new things have been added in that goes into their FAC, but there's been no supplemental actuarial analysis done to see what the cost of that is going to be. And I'm sure there are other places. I just know that we kind of policed ourselves on it from the firefighter 335 union side. Want to make sure it's being done across the board so that it doesn't present an issue later in the future.
Like I said, Chris, I can never remember,
Getting any of those.
the city has done them. I've seen them. I know the flag did them
Mhm.
During negotiations, find out what the effect was.
And then
But we were never involved because we weren't part of the negotiating team.
I would think it'd be a good idea. Not only do you get those actuarials, but if you guys could be updated, like if I guess I'm kind of covered. If you got that supplemental actuarial, it would bring to your attention what changes have happened. So when you're reviewing the pension to make sure it's falling within the parameters or whatever, then you would know what things we're looking for, what was supposed to be included, what wasn't supposed to be included, and maybe any red flags up
I know.
at that point. So,
A couple of times I've been questioned by Benke, Mayor, the contributions rate, and I says, well, when you guys approve contracts and there's changes in benefits, that affects it, because part of that has not been funded. You got guys close to retirement, oh, things are gonna get better for them right off the bat, because they're gonna retire in the next couple of years. I says, that affects that,
Yeah,
But
they-
that's-
and,
you know,
but that should be accounted for in the supplemental
yeah.
actuarial,
Well, that's, then he said, well, it's spread over 30 years, or
maybe,
25, you know, based on.
if one was done, so that we have the numbers to know then. So those are
Wow,
my-
great call out. So do you guys hear about these in the finance department? Because when they're doing the negotiations, do they feed into you guys questions? How much does this cost? You know, this is something we're looking at for a benefit.
I think there's some of that, and maybe Linda can speak more to it. I know when I was in Big Rapids, I was the secretary of the police and fire pension board up there, and we evaluated a COLA adjustment for our retirees, and as part of that, we did a supplemental evaluation. But that was really the only one that I ever recall having any experience with.
So, yes, we talk about the financial implications of things, but very infrequently is there a change to a pension benefit. And so I'm not very clear about the $4,000 you're talking about a piece for the BCs. But I think that the contract for BCs detailed out what was already being included in everyone's FAC. Lily, help me out if I'm wrong. I don't think there was anything added to enhance their benefit. So
I think there were.
then we'll have to look, but we know that particularly if there's anything that's going to be not immaterial, that yes, there should be an actuarial valuation done. And it would be mine or the labor attorney's responsibility to put that in front of this board.
Okay.
But I'm typically not involved when it goes to the city commission. So
It's generally
closed
would be Nancy.
session. Right.
Mullen.
It's typically
She's the
closed
one for
session. Right.
negotiations and.
Right.
But Stan said he's never
Well,
seen.
yeah,
it.
the one, I don't think the pension board's ever seen,
I think when
unless it's something that just got as an attachment to.
And maybe it's happening. I'm
It's-
just
it's
saying,
just
we
a-
had good practice.
and really what it is a notification. I think we went around with Joe Newman prior to you being chair. We went around with Joe Newman and Gil Bradstreet about the pension board being made aware and being privy to the actuarial valuation. Because I think back in that period of time, there were some changes to FAC calculations and what was included. But
That
that's
one
been
time-
a while ago.
Yeah, one time, we included, educational allowance.
Right.
And that came out of a lawsuit. So he was sued because he weren't putting it in, and it was Doc Blanchard that filed the suit. And the courts agreed with him that it should be part of final average compensation. And there should be in his file, copy of the order from court. So. But that goes back.
But you bring up a good point, Chris, you know, that, yes, there just needs to be some awareness and sharing of information. Yes, I understand.
I'm all for everybody negotiating the best deal they possibly
Sure.
can, you know that.
Sure.
I just want to make sure it's accounted for.
Sure.
Yeah. So I can handle it when time comes.
That's right.
It'll come to haunt at some point. There's nothing else on the public comment. Let's look at our next meeting date. One is Monday, November 21st. What's the-
So Monday, the 21st November.
We've always referred. I'm available.
Okay. So it's Monday, the 21st November? Is that what you said?
Bucket down.
Yeah.
Okay, yeah, that works for me.
Works for us. That was the day we had help for the.
Yeah.
That's nice.
Wow.
Oh, we are changing. Right, how'd that happen?
Yeah, gonna bring a wheel in here with dates on it. Just spin
Yes,
See
so
what
not to
one
get into
comes
minute
up.
details, but Loomis Sales is the one manager we have that typically still has to sell actual bonds. So they'll ask for 3 to 5 days to essentially sell their allocation. You won't be able to transfer and make trades. So
Oh, likely sure.
yeah, exactly. Week to 2 is essentially how I take them. But
Well, I guess we can adjourn. Thank you, Jeremy.
Yeah, good to see everybody.
Hopefully it's better, yeah, better news.
Absolutely. I know, exactly. It's been a rough quarter, as you can imagine.
What are they planning?